Yeah, unfortunately, I mean, look, your panel described it for the most part. I mean, look, the risk setup is worse today than it was 3 months ago, just with the war itself, or just that alone. Okay, it doesn't even take into account the Fed moving faster now and the risk that that has on the economy. I mean, these are real changes that are for the negative. And so you can't be more positive than you were in December. And we were negative then. And the price isn't that difference at the S&P level. Now, the good news, Scott, as we've talked about a million times on this show, okay, we're in a bear market. We've been in a bear market for a while. It started a long time ago. We've done a lot of good work at the stock level. And actually, last year, the average stock underperformed significantly the S&P. This year, it's probably going to be the opposite. Okay, so what you guys are talking about, picking off names that have already been hammered, that's the strategy now. Get away from the S&P 500. It's a trap. Okay, like thinking about the S&P is, that's not what investors do. Investors look at individual names, and that's what you need to be doing. Now, at the S&P level, we're absolutely more bearish today than we were a month ago because the price is adjusted. And we thought there'd be a rally to 4,500. We wrote about that. Here we are. It's a bear market rally. And look, the numbers you guys are throwing around, I would throw 16 times. That's the right number right now, given where rates are. Okay. The equity risk premium today is 280. That's the lowest equity risk premium that we've had since the GFC. Okay. That's the lowest number. Does that make sense to anybody? 280 equity risk premium. You're not getting paid to take equity like risk at 280 basis points. No different than credit spreads, which have blown out here recently. So what's the right equity risk premium in this environment? We have a war going on. You have a Fed that's moving us to inversion quickly, and growth is, not negative, but it's slowing. Okay, that setup says 400 basis points. That's 16 times. I don't think it's that complicated. The hard part is knowing when we're going to get to 16 times. Is it going to be next month? Is it going to be 2 months from now, 3 months from now? I don't know. But I'll tell you this, I'm not that interested in buying the index until we trade to 16 times.
Let's be clear. Your base case on the S&P is 4,400. So for all intents and purposes, we're there, right? I mean, so that's your base case. Your bull case is 5,000. So a better chance than not of being right around where we are in the ballpark, or perhaps better, 3,900 is your bear case. Now, I'll agree with you when you said the risk picture, and I wrote this down because I want to make sure I got it right. The risk picture is worse than it was 3 months ago. Can you not make the argument, though, that the risk picture is better than it was 3 weeks ago, right? Because more is known, right? We know now what path the Fed appears to be on. We've been able to absorb this higher move in interest rates. And I'll tell you what, I know you could cite some earnings revisions being negative, but earnings thus far ain't so bad. And maybe Nike tells you that yesterday, that maybe things are going to be all right when it comes down to earnings, and the market can handle a move higher in rates. So maybe the picture's better than it was 3 weeks ago, but not 3 months ago.
I don't think the picture's better than it was 3 weeks ago. We're closer to the sun now, right? We're closer to where the revisions are going to get more negative. And you're exactly right, though, Scott. The thing that's held this market up is earnings. Josh said the same thing. That's exactly correct. But the price is wrong because growth is not going to be as fast as it was, obviously, the last 2 years. Nor is it going to be as fast over the next probably 5 years because you pulled forward a bunch of demand. That's not the end of the world. We're not even calling for a recession. You don't need a recession for valuations to normalize. 16 times is a normal multiple given where rates are and given the setup that we have in front of us from a risk standpoint. So I do not think the risk is better than fears, mainly because price is higher. How could it be better if price is higher and risk premium is down 40 basis points?
Yeah, but I want to argue with you on one thing here. You said you pulled forward all this demand. I mean, you might have pulled some demand forward, but demand is going to be off the charts this summer, albeit unfortunately at higher prices. But you can't find an airplane seat that's not, that's not full. You're not going to get hotel rooms. I mean, demand is going to be robust for a while. Why wouldn't it be?
Right, which is why we're not going to have a recession. There's going to be a share or a wallet share shift from goods to services, not nearly as accretive for the stock market, okay? The consumer discretionary sector is 85% goods, 15% services. The economy is only 30% goods, but 70% services. So it's good for the economy, not great for necessarily S&P 500 earnings. It's that simple. It's just the math. And look, the reality is I'm not that sure that we're going to have the 6th reopening that we've had at this point. yeah, demand's going to be good, but those seats are already full and the hotels are full. So where's the incremental capacity going to come from? We're already bumping up against that. I'm not so sure that demand isn't already robust. I mean, it's already robust for a lot of things.
Well, my headline here from you now is no recession. So as bad as you think it is, you think the Fed's going to be able to engineer a soft landing?
Well, define soft. I mean, if soft is
well, no recession. I mean, they're not going to crash the plane.
Well, it doesn't mean. I mean, let's talk about what we're trying to figure out in terms of the markets. Okay, a soft landing is that, yeah, the economy doesn't go into recession, but you can have a stock market that comes down severely, and there could be stress in the economy from that tightening. But yeah, why can't they engineer a softer landing than what people are saying? That could happen. Okay, but growth is going to slow either way. And something we've written about extensively, the risk of recession next year has gone up significantly. Okay, the risk of recession next year has gone up. And as Josh said, once that curve inverts, okay, the clock starts ticking, and usually within 12 months. So no recession this year. That's our call. Next year, we'll see. The market is going to start to figure that out. That's another reason why multiples are going to come down, right? This is the fire and ice. Fire, we already know. That's Captain Obvious now. Everybody knows it. Okay, the ice part is the part of the trade now where the multiples get ahead of the earnings revisions to the downside.
Well, we're going to see, right? There's no guarantee.
That's right. We're going to see. I'll be paying attention.
Oh, I know you will. We're going to be paying attention as well. Let's take a break. Can you stay over the break? I want the gang to get in on this. All right. We'll be back with Mike Wilson. We'll get the gang involved here. Financials, by the way, among the top gainers today. There's a bullish note.
Record of soft landings engineered by the Fed is actually not great. So 1965, 1984, 1994. I think in all cases, we had a great demography and we had a roaring economy. And the soft landing was really just about trying to prevent inflation. This is a very different situation. Inflation is here. It's worse than anyone on the board expected. It seems to be caused by things other than the economy, which is a little bit tougher for the Fed to address. Why do we think this this attempt at a soft landing will be successful where so many others failed and recession became the result?
Yeah, look, I mean, I'm not opposed to a recession potentially happening. Quite frankly, I would strongly suggest that we need a recession. Okay, we need to curtail demand. I've always said that we don't have a supply problem, we have a demand problem. The reason we have inflation is we overstimulated the economy and we created excess demand that led to, this surge in prices.
Well, we have both.
Well, okay, but we're producing way more stuff than we were pre-pandemic. Okay, it was a demand problem. We can debate that another time. The point is that if we got a recession, it would alleviate a lot of the inflationary problems. I don't think the Fed's going for a recession. Okay, let's put it that way. Will they be successful? I don't know. It doesn't matter to me, though, Josh, because at the end of the day, earnings are still going to slow and the price is wrong. So I don't even need to make a bet on a recession at this point to say that there's downside to the S&P 500 from 4,500. And that's sort of the point. I'm not trying to solve every puzzle out there. I'm trying to solve a puzzle that I can fix, and I know what that is that the price is wrong. So let's just get that right first, and then we can debate whether or not there's going to be a recession.
Pete, you got a question for Mike Wilson?
Yeah, Mike, thanks again for coming on. I know it's always difficult, but I will ask you this. So you talked about individual names.
You mean it's always difficult? Why is it always difficult? What are you talking about? It's always difficult.
He gets a hard time he gets a hard time for people. But Mike, very seriously, the individual names, like you mentioned that earlier when you first started. I'm curious. I know you can't go over the individual names, but what sectors? Is there a specific area of the market, maybe 1, 2, 3 sectors that you'd say, you know what? Our economy's this, we're going to see a lot of pressure to the downside, but this is an area that I think you can actually is investable. Is there a specific sector you'd point out?
There's several, Pete, and thanks for your comments. I mean, look, healthcare looks extremely attractive in both a valuation perspective, and that's an area where there's pent up demand. It's also defensive, which is in line with our general defensive posture. Okay, and look, I mean, unfortunately, this war is terrible, and we all want it to be over. But there are some structural changes that are going to result from it, even if it ended tomorrow. There's going to be more spending on probably energy services. There's going to be more spending on, defense and national security. And that would be software security as well. So those are new trends that are just emerging here right now. And really just the inflationary trends that we're going to see in materials, right? We're taking off a lot of supply permanently, regardless of the outcome of this conflict.
Mike, we're going to leave it there. I hope this wasn't too excruciating for you. Know how
Always my
difficult,
pleasure.
know how difficult it can be sometimes to answer some real questions, but I hope it worked out for you.
Anytime, Scott. Anytime. Good to see you.
All right, that's Mike Wilson, Morgan Stanley.